Good afternoon from DBS. This is Timur Bey, Chief Economist, with my colleagues Philip Wee, Senior Currency Strategist, and Ma Tieying, Senior Economist. We are here with you for our December Macro Insights live stream, the last one of 2024. We have already presented our annual outlook. In fact, we covered it in the last live stream in November. Today is basically taking stock of the whirlwind of geopolitical developments we have had in the last couple of weeks. And also the sort of Trump trade expressing itself in a variety of currencies. And therefore, we have Philip with us to go over the 2025 currency forecast, which we have gone ahead and revised quite a bit in the last few weeks or so. But first, I will step in and team, let's put up the outline of the presentation. I will talk a little bit about my recent travels. I met with DBS Bank clients in Switzerland and UK last week, and we'll share some of the takeaways from that. After that, Tieying will take care of some of the really hot developments, particularly out of Korea, but also what's happening in Japan and Taiwan, and both with respect to politics of those countries and their economic outlook for 2025. And then Philip will step in with Fed, Trump, and currencies. So before we get into my side of the presentation, there is the QR code for questions. Please go ahead and submit your question by scanning the QR code. If you cannot scan, just type dbs.pigeonhole.at, pigeonhole.at, and then enter the passcode DBS macro. So either way, scanning the QR code or dbs.pigeonhole.at with passcode DBS macro will allow you to not only just submit your questions, you can also upvote the questions that have already been submitted. We will bring this QR code back in between our presentation, so you will have other opportunity to submit questions as well. All right, let's proceed. So notes from UK and Europe. So I have a few considerations. Look, I mean, I went through Europe at a time when the government in France was falling. There were all sorts of political challenges in Germany. There was the developments out of Syria, Israel's intervention there as well, following on their intervention in Lebanon and elsewhere. So it was geopolitically a hot week. There were very depressed set of clients as far as the European outlook was concerned. And even the clients that we met in London discussing Europe and UK, it's not like the Starmer government is off to a very smooth start either. There were quite a bit of concern about what's happening in the UK with respect to fiscal austerity, with respect to institutional reforms, immigration reforms, relationship with Europe, and so on. So it wasn't the best of times for investors sitting in Switzerland and Germany and the UK, but that, interesting enough, made them far more interested in the developments in Asia, especially with US inauguration in mind. Who will be the winners and losers sectorally, geographically, regionally, and also the fact that there is substantial amount of savings and high net worth individual investments in Asia, including Southeast Asia, that we heard from several buy-side companies that they are thinking about developing funds with Asian investors in mind, marketing them in Asia. In fact, I met with one company which is moving staff to Singapore and planning to basically start offering high yield credit funds out of Singapore for high net worth individuals, both with exposure to Asia and also Europe. The other issue was related to currencies. Given the sort of overvaluation of the Swiss franc and the overvaluation of the US dollar, there were some questions that, is this a good time to be long the euro given how cheap it has become? Or is there further room to weaken, especially given how poor sentiments are? And related to that issue was also, where does the ECB go with rate cuts? Can it continue cutting rates in the face of crosswinds coming from the US with respect to tariff and so on? Or maybe is it exactly the right thing to do if the Fed is pausing and the ECB is cutting, opening up rate differentiation in favor of the US dollar and against the euro? Maybe that is a prescription Europe needs, especially since all this discussion was taking place around the backdrop of the auto manufacturing in Europe, particularly in Germany, which is facing tremendous competition from Chinese imports, and what happens to the European car industry if these cars indeed become very attractive to European buyers. So all that stuff was there. I felt that being there allowed me to sort of present the Asian case to actually a fairly receptive audience. Given what's going on in that part of the world, they would want to be long this part of the world, and that was a good takeaway. But in terms of near term, like the next 2 months, nobody was particularly constructive Asia. Everybody basically was going along with what we call the Trump trades, long US dollar, long gold, long crypto, long US stocks, and short US duration. I didn't really find a single meeting or an investor at the other side of my table who felt that there should be any other view contrary to any of these ones. But this is a very short-term tactical view. Selling the news on the 20th of January is one set of view, that the kind of nosebleed valuation that US assets have, it is simply not sustainable once Trump comes to power and the reality of policymaking sets in again. One illustration of the potential difficulties Trump might face is that the Democrats are actually, only just a couple of seats deficit in the US Congress and the House. So they would, by they, I mean the Republicans, would need basically every single Republican House member to support any legislative measure. Even one or two dissension could lead to bills falling apart, presuming that Democrats will be holding together against any of these tax cut measures that Trump is talking about, or any other measures around immigration and so on. So, and I think that realization will only set in once Trump takes office, not necessarily now. Now the view is that the art of the deal is very much alive and Trump can make things happen. That euphoria in some views, and I must say that I probably share that view as well, is that euphoria could abate very, very rapidly once Trump takes over the office. So for the next 2 months, underweight Asia, short duration, and all the other stuff like long USD, long gold. But going past January, going into February, March of next year, you can make a case for substantial correction in asset prices in the US, which then benefits asset prices in the rest of the world. So this is one of those cases where Trump's zero-sum narrative really plays out, not just with respect to tariff, but also with respect to financial markets. The chance of Asian assets to receive flows around that narrative in the second quarter of 2025 and further beyond, I think is decent. As I said earlier, I've already seen, at least with respect to credit, quite a bit of interest among buy side to invest in Asia. There's decent yield. If indeed the Asian currencies bottom out by the second quarter of next year, there's decent carry as well. And right now, from a cross-currency basis perspective, it doesn't look very attractive, but that basis attractiveness could improve if indeed we start pricing in volatility in the US, volatility around US dollar, and uncertainty around policymaking. That could all help Asia in the second half of next year, maybe even earlier, as early as the second quarter of next year. One point going into 2025, I mean, we're speaking to you on the 13th of November, we're going to have US inflation print tonight, is that what if the market narrative around the Fed changes quite dramatically in 2025? For most of this year, we've been expecting a recession, substantial rate cuts. Now we're not expecting a recession. We still are holding on to a few rate cuts in the expectation that Powell will feel obliged to do that, not just cut rates during Biden's time, but also follow through Trump's time. But I think that window has certainly become narrower over the last few months. Inflation, regardless of tonight's print, has sort of gotten stuck at the core PCE level around 2 3/4, about 2.7-ish. And we see makings of a rebound in core PCE inflation in 2025 from housing, from services. If that were to happen, and couple that with the tariff threat of Trump, which can also add to goods inflation, we could have some serious questions around the Fed narrative of steadily cutting rates in 2025. They may not be in a position to hike rates because nominal rates are seen quite high relative to 2.7, 2.8% inflation, but they certainly would not be able to cut a lot more. That, of course, would be constructive the US dollar. So some of my thesis that in the second half of next year, we can see substantial market sell-off and current rally in Asian currencies and assets will also have to reckon with this possibility that the Fed is not able to cut, even in the face of market mayhem, cannot really support things. That could be pretty challenging for a systemic risk perspective. Bank duration exposure, financial stability issues around a large sell-off, all of those things will come into play. So it could be a rather volatile year, a year of two halves, but we will probably start the year exactly the way we're ending it, which is very strong momentum toward US assets. But I will be careful past January with that regard. And again, just like the Trump trades were not something that I found any deception during my trip through Europe, I didn't find much deception about this two-half story either, that there's a possibility that we could have a year very different end versus the way it starts in 2025. Anyway, so that's it for me. We will come back in early January in the next live stream. We'll talk about some of our favorite trades from a strategy perspective for 2025. But that's for next month. Right now, I'm going to hand over to Tieying, who's going to talk about the three hot countries right now. Tieying.
Thank you, Taiwan. So in the next maybe 20 minutes, we want to take a look at three major economies, Japan, Korea, and Taiwan, their latest politics and geopolitics developments, and how this impacts their economies and their financial markets. In Japan, there are two major events recently. One was the LDP party leadership election in September. Another was the general election in October. So during the LDP election, September 27th, Mr. Ishiba was elected as Japan's new prime minister and also the new leader for the LDP party. This event, in fact, triggered some significant movement in Japan financial markets, including the currency markets. So the Japanese yen, in fact, strengthened versus the US dollar, rising around 2% during a single-day trading. That was because Ishiba was considered as a relatively hawkish candidate on monetary policy. He supports monetary policy normalization by the Bank of Japan. He supports stronger Japanese yen to mitigate the inflation pressure on Japanese consumers. Subsequently, on October 27th, there was a general election in Japan. During the general election, Ishiba and his LDP party lost the majority in the lower house. For the first time in 15 years, the LDP party lost the majority in the lower house. This event has some implication for Japan's medium-term and longer-term economic policies. So if you look at the key policy proposals by LDP and also by the opposition parties, you can see that the opposition parties in general, they support fiscal policy expansion. They support higher spending on social welfare and also increase of the personal income tax threshold, or even the reduction of consumption tax rate. So this may result in some sort of further expansion in Japan's fiscal policy and increasing Japan's already high public debt burdens. And for monetary policy, there is no strong view, no strong consensus among the LDP and opposition parties regarding monetary policy direction. So the largest opposition, CDP party, they support monetary policy normalization. In fact, they want the BOJ to revise its inflation target from 2% to above 0%, essentially lowering the bar for BOJ to raise interest rates. On the other hand, some small opposition parties, GIP party, for example, they support monetary easing. They propose to revise the BOJ mandate to include some additional mandates, such as job creation. So for monetary policy, in fact, there is no strong consensus among the different parties. The implication for monetary policy is not very clear. So beyond politics, how the Japan economy is doing and how the Bank of Japan will decide its monetary policy based on the economic performance. In this regard, we see some reflation progress in Japan. So wage growth is picking up. and inflation is also picking up. So a virtuous cycle of recovery driven by higher wages and higher prices seems to be building up in Japan. If you look at the first chart, the wage data chart, you can see it's significantly improving. Total wages, base wages, they're both going up, currently approaching 3%. 3% wage growth is important for Japan to create 2% inflation on a sustainable basis. 3% wage growth is essential for Japan. And inflation data, the second chart, you can also see inflation data holding up. The CPI, core CPI, and also the so-called core CPI, excluding fresh food and energy, they're generally holding up around 2%. So the policy rate in Japan currently is significantly below the inflation levels. Real interest rates apparently is negative. There is a scope for BOJ to normalize monetary policy to raise interest rates. The BOJ already raised rates at the July policy meeting, and after the July rate hike, we expect the BOJ to hike rates again during the January policy meeting from 0.25% to 0.5%. And if the financial market conditions remain stable, there is also a chance for them to bring forward this rate hike to the December policy meeting. There may be around a 40% chance they will consider an early rate hike at the December policy meeting, which is on December 19th. We now move on to South Korea. South Korea, there is a political crisis happening. So last week, on December 3rd, suddenly there was a martial law announcement by South Korean president. That triggered like a very important, very big shock to the Korean society and also to the international society. The martial law was lifted by the National Assembly overnight within 6 hours. But still, this also triggered the financial market movements. The KRW, for example, depreciated significantly versus US dollar by about 2% during that day. And the crisis currently is still ongoing. Over the weekend, the National Assembly voted to impeach President Yoon, but without sufficient support from the ruling PPP party, the vote did not pass in the National Assembly. And currently, the opposition parties, the Democratic Party, is trying to push forward another round, second round of impeachment, which will happen this weekend. To pass in the National Assembly, this will require 2/3 majority support. And after that, it will also require the Constitutional Court to review and make the decisions, which can take up to 180 days. And after the court make the decision, there will be an election, which will happen within 60 days. And on the other hand, the ruling party, PP party, currently, they still prefer to allow President Yoon to step down in an orderly manner. They want him to step down voluntarily around March 2025. And that will also be followed by election within 60 days. Between now and second quarter of 2025, we may see the political uncertainty to continue, and that may continue to weigh on the investor confidence and consumer confidence. To be more forward-looking, if there is an election, and if the opposition party, DP party, takes power, there could be some significant change in South Korea economic policies. So the DP party, traditionally, they emphasize the social welfare spending. They may call for expansion of fiscal policy, which will increase South Korea's public debt burdens. And the PPP party, the ruling party, PPP party currently, their focus is about those pro-market and pro-business reforms. So during President Yoon's term, in fact, he pushed forward some reforms, such as further opening up South Korea FX and bond market to foreign investors, extending the KRW trading hours, including Korean bond KDB into a global bond index, and also trying to boost the valuation of Korean equities through the so-called corporate value up program. So if PPP loses the election and DP party takes power, these reforms, they may not be the priority anymore. The momentum of these reforms probably will slow down. So how about the South Korean economic performance? Well, in fact, even without this political crisis, we see the economy is slowing and is facing some challenges. Here we have indicators showing South Korea manufacturing production, services output, construction output. So as you can see, the manufacturing sector is still holding up, but service sector output is slowing almost 0%. And construction sector output, the growth is negative. So essentially, exports are still doing okay, but consumption is weak. That is due to the high interest rates and also the high household debt burdens. And the permanent market is also sluggish, and that is due to the government tightening measures. Inflation side, inflation pressure is easing. The CPI inflation, both headline and core CPI, they are falling significantly below 2%. So real interest rates, they are significantly positive, and there is space for the Bank of Korea to cut the interest rates. During the recent two meetings, October and November meetings, the BOK already cut rates by 50 bips in total. We expect the BOK to cut rates further at the January meeting by another 25 bips. And we currently expect BOK to cut rates towards 2.5% by second quarter 25. If the political situation remains uncertain, and if the domestic growth continues to slow, there is a chance for the BOK to cut rates even further to around 2.0% by second quarter 25. Finally, Taiwan. In Taiwan, the focus is about geopolitics, the upcoming Trump 2.0 scenario, and how this is going to impact the geopolitics situation. So in the middle of this year, in July this year, in fact, the consensus about Trump 2.0 that triggered some kind of stock market correction in Taiwan. In July this year, Trump made some comments on Taiwan. He mentioned that Taiwan is receiving some kind of U.S. military support, and Taiwan needs to pay the U.S. The so-called protection fees. And these comments, together also with some external factors, such as the global tech sector slowdown and the yen carry trade unwinding, that triggered a significant correction in Taiwan stock market during the July-August period. In addition to geopolitics, investors are also concerned about the trade tensions, tariff tensions coming from the new Trump government. So Trump is already talking about tariff increase on China, and that will also hurt those China-based Taiwanese companies. The China-based Taiwanese companies, such as those electronics ODM makers, they have already diversified their supply chain since the 2018 US-China trade war. They moved some of the production from China back to Taiwan and also to Southeast Asia, to Mexico, to Eastern Europe. However, even after the diversification, China remains the primary production location for Taiwanese companies, still accounting for about 40% of their total production. So if the US increased tariff on China, inevitably it will also hurt those China-based Taiwanese companies. And Trump is also talking about universal tariff. So that could also include direct tariff increase on Taiwan. So as mentioned, after the 2018 US-China trade war, Taiwanese companies diversified their production locations, moving some of the production from China back to Taiwan. So as a result, Taiwan's domestic production ratio has increased, and Taiwan's exports to the US have also expanded. So among US top 10 import countries, Taiwan now is number 8. Previously, it was number 9, but it now has moved up to number 8. So if there is a direct tariff increase on Taiwan, that will also have some notable impacts on Taiwan exports and on Taiwan economy. How about ongoing economic trend and policy trend in Taiwan? The ongoing trend, in fact, is stable. The key indicators, export orders, exports, and industrial production, we saw some deceleration in recent months, but the deceleration is moderate. It's not too drastic. The key sector in Taiwan, the semiconductor sector, in fact, remains in the expansionary territory. The growth rate has slowed, but the cycle remains expansionary. Historically, the global semiconductor sector, the expansion cycle is around 13 months on average. The current cycle of expansion started from September last year. So by end of this year, it's around 15 months. It's just halfway. And based on the historical experience, this expansion cycle can continue for another 15 months into 2025. Although the growth momentum is slowing, the cycle remains expansionary. And inflation side, we see inflation remains stable in Taiwan. The CPI numbers are still around 2%. Policy rates are also at 2.0%. Real interest rates is about 0. No strong reason for Taiwan Central Bank to hike rates or to cut rates. There is a central bank policy meeting next week, December 19th. We expect the central bank to keep policy rate unchanged, still at 2.0%. During the recent meeting in September, the Taiwan Central Bank, they raised reserve requirement ratio. Then they also raised tightened the credit control measures to cool down the property markets. For the upcoming meeting, we expect the central bank to keep the RR ratio and credit control measures unchanged. After the September round of tightening, in fact, there is some kind of correction in the property market and also in the credit market. So I think the central bank, they will wait for a while. They will monitor the effectiveness of the last round of credit control measures, credit tightening measures, before deciding whether further tightening measures is needed. So this is all I have for these 3 economies. I think.
Dean, why don't you put up the QR code for the people to Phillips, because I want to ask you a question, but during that time, have the QR code of the Q&A up. Excellent. So team, this is my question. I've been reading on Nikkei that Japan is now beginning to get very interested in revamping its semiconductor industry. And we know that at the DRAM space, Koreans are still doing, cutting edge work, but at the very, very high end 3 nanometer, it's really, really Taiwan. So how do you see these countries? They all have their own pockets of excellence in semiconductor manufacturing, but they seem to have all sort of given the lead to Taiwan. That is there a chance in the next 5-10 years we see Korea and Japan reassert their lead, or Taiwan is here to stay number 1 for the time being?
I think most likely Taiwan will maintain its comparative advantage in the coming maybe 3 to 5 years. So TSMC is already producing a 3 nanometer, and next year they will enter into 2 nanometer.
And nobody can produce 3. Nobody else.
Samsung can do, but not so competitive as TSMC. And in South Korea, in fact, their strength is more about memory chips.
Yeah.
Yeah.
The DRAMs, yeah.
Yeah. Taiwan is more about logic chips. So there is some kind of difference. And for Japan, the advantage is more about those semiconductor equipment and materials. It's other parts of the semiconductor ecosystem. So the semiconductor sector, to maintain competitiveness, one thing, of course, is about the very large scale capital spending. So TSMC is very profitable. It has the capabilities to continue to spend. Of course, Japan, Korea, they can also spend, especially with some kind of government subsidies, they can also spend. But this is not only the only one element for semiconductor. So TSMC also has other advantages. For example, it has those engineering know-how and also has a very strong partnership with the US tech sector suppliers, with both upstream, the software suppliers, and also the semiconductor equipment producers. And this partnership relation has been in place for a very long time period, it's several decades. So I think TSMC's leading position may not easily change in the coming years. But of course, other countries, Japan, Korea, or even the US, they can make some progress. Their share in global semiconductor sector can increase maybe modestly. But this will not change TSMC's leading position, probably.
Two quick follow-up questions. One is TSMC's expansion in the US. Is it going pretty well, or is it like behind schedule? So the Arizona plant they want to open. And the second one was I just read about Taiwan opening, China opening an investigation on NVIDIA, and if that has an impact on TSMC as well.
Yeah, China is doing an investigation on NVIDIA, but so far as I know, both NVIDIA and TSMC, the exposure to China market is not very big. China currently accounts for around 10 to 11% of NVIDIA and TSMC's total revenues. It's because US has already tightened the semiconductor control on those advanced chips for about 1 to 2 years already. So that is not very new. In fact, both NVIDIA and TSMC, they have already diversified their revenue base away from China. And regarding TSMC's operations in the US, so far it's ongoing. So they are going to produce 5 nanometer, 4 nanometer chips in 2025. But there is also a challenge because after producing the chips, they still need to ship these chips back to Taiwan for assembly and testing. Yeah, okay. Because the semiconductor ecosystem supply chain in the US so far is not comprehensive. So still facing some challenges. And I believe under Trump 2.0, there will be more pressure from the new US government requiring TSMC to invest more in the US to bring more advanced technology to the US, like 2 nanometer, 3 nanometer. There'll be more pressure on TSMC. In the end of the day, I think there will be challenges for the company because the profit margin, there will be some negative impacts. But it's also a chance for the company to further secure the partnership with US tech companies and also to further consolidate their consumer market position in the US.
Okay. Another day, I'm going to ask you about China's attempts to build lithography machines, but let's put that aside. All right, we have kept Philip waiting for a long time. Philip, all yours, FX.
Okay. Okay, my job today is just to explain why we have changed our view. The profile is now different. Previously, we were looking for the dollar to be lower in the first half of 2025. That's pretty much our Fed cut view. Okay, so which has been overtaken by the Trump tariff threat. So unlike his first term, tariffs are not going to come in the second year, but at the outset of his presidency, his inauguration is on 20th January 2025. Okay, so but we've put the medium-term dollar weakness story, push it pretty much to the back. Looking at his policies, it could be negative for the dollar fundamentally. Same worries about fiscal sustainability. inflation comes back, will this also be linked to overheating? And of course, whether there'll be backlash, and instead of discouraging de-dollarization, it can actually pick up momentum. But in the end, these are still what you call expectations. So Trump hasn't come into office yet. You still need to see the actual policies to see if they're aggressive, if they're credible. Some people think that it may not be it may not be as bad as initially thought. But nonetheless, I think this presentation, we would like to also bring some reality check into the current landscape. Okay, why did we keep the dollar up in the first half? Well, we thought we must well just look at the first year of the tariff war in the first term, and that's 2018. So the renminbi actually started weakening from April. The sharp move was really over the first 3 months, but it continued to drift lower right into October. So so in a sense, it's a 6-month period. So that's why we thought that we might as well, put in, the first 6 months, given that the tariffs are going to start, at the beginning of the term. So when we compare how Asian currencies have done, tagging from April, what's interesting is that Indian rupee and Indonesian rupiah were most correlated. So, but once they sense that some stabilization, they were also the ones that were quickest to rebound. And Southeast Asian currencies, pretty diverse behavior. So again, Thai baht and ringgit are more volatile, just as they have been during the Fed hike cycle. So they drop very quickly, but then they also stabilize. But when the Fed turned dovish, these currencies tend to come back also very quickly. So peso and Vietnam dong tends to be more stable. But I suspect that there'll be more pressure, especially on the Vietnamese, to allow the currencies to move more to reflect the fundamentals. Okay, so the Northeast Asian and the Sing dollar on the right-hand side is amazingly correlated. So they all move together. And then they more or less talk about 50 to 60% of the Chinese yuan's sell-off. So not so sure whether this time round you're going to get same kind of correlation because we still have a very weak Japanese yen, as well as political uncertainties that you've heard from Tieying in Korea. Okay, sorry. So on the Fed story, so previously we were looking for Fed to cut, at one point to 3% next year. Then we pulled it back to 3.5. So next week the FOMC is probably going to deliver the third cut, but there are already signals that the Fed is beginning to look at inflation or the disinflation stalling. That is likely to overcome the job worries that was responsible for the 50 basis cut that we saw in September. So chances are they may signal a pause after 3 cuts in January, and maybe move on to a quarterly move. We'll see. Okay, so BOE has been doing quarterly rate cut cycle, and they've just confirmed that they plan to do 4 more cuts, for next year, probably at the same pace. Okay, so when it comes to the dollar, especially at DXY, you need to recognize that the euro is the largest component. So, and at this point, Europe is not really in a good shape. So that's probably an understatement. Okay, so you have so many worries, right? The economy is not doing well, especially the large economy like Germany and France, and the governments have collapsed. So, and they are looking at possibly elections, and of course you have questions about Ukraine and the implications for NATO. So when Trump comes in office and tries to broker a deal, a sort of a ceasefire deal, between the two. Then on the trade side, EU is not going to be spared from tariffs, but this time round, the EU is also worried, that the tariffs on China would push more of their, exports into Europe. So, so not surprised, that the ECB, when it next meets, is going to be pushing, for Brussels, and the EU nations to move towards fiscal union. Because at this point, I think ECB, while is now more optimistic about inflation hitting the 2% target next year, but when it comes to the economy, I think they've always felt that it is the job of fiscal policy. Okay, I'm going to skip the rest, but just want to highlight a couple of things. One is that RBA just met, and it has sort of toned down its neutrality. I think it's sort of now opening the door for a rate cut in early 2025. So at the same time, when we think the Fed's going to pause. So on the yen carry trade, yes, there's been some winding of the Aussie yen, but I think the challenge is that unlike the July unwinding of the yen carry trade, where we had Powell paving the ground for the 50 basis cut, we also have a BOJ that is that become more resolute in terms of normalizing policy. So those kind of factors aren't going to be as strong as what we have seen. Okay, so coming back to tariff, I think we need to spend more time to compare between the tariff in Trump 1.0 and 2.0. Okay, so by and large, I think I try to be as comprehensive as possible, and to keep it simple. I think at the end of the story, the story is that there's a risk that there's going to be a significant expansion in terms of scale and scope. Okay, so Trump 1.0 was really focused more on the trade side, to get leverage in renegotiating trade deals, and it was also pretty specific. Whereas this time round, he's talking about on all imports, from Canada, from Mexico, and from China, and it's not just about trade; it's also about non-trade issues, that's linked to his political pledges like illegal immigration, trafficking, and now, of course, challenges to the dollar's global status. So, and but in the end, yes, market thinks that Trump is likely to be transactional, but at the same time, a transaction, has two sides. So we also need to see how much, the other side of the country is willing to meet him halfway, and he's not making it easy. So for example, he has called the Canadian leader, governor twice. So moving on. Okay, moving on. There's been quite a bit of, I think, relief, optimism when Scott Bessent was nominated as Treasury Secretary. A lot of hope that he'll be more measured, but I can't see him, not, aligning with the hawks, the other hawks that are nominated in Trump's cabinet. So here, just highlighting the sort of tone that all these individuals represent, so it's not just about trade, okay, but they're all pretty unified in terms of tariffs. So the Commerce Secretary was the one, if he comes in, he's the one who advocated the 60% tariffs on Chinese imports. And then there's clear push back towards strategic decoupling, and also in a sort of sense that now they're looking at the US-China tension as a new Cold War, and focusing also on China's trying to diversify and build its influence, let's say through Belt and Road, and of course, the BRICS. So it's going to be, I think, going to be quite challenging. Something that we need to guard, our complacency going forward. Okay, so but in the end, we still need to be being cautious. Okay, so the other optimism is also that China hasn't been idle after the first Trump term. So we have seen quite a bit of progress in targeting their competitiveness. For example, Chinese EVs have leapfrogged those in the US and EU. They're the largest producer of solar power. They're also making inroads into new sectors. I think the first AAA PC game this year was quite interesting. Created quite a lot of interest. And of course, it should be watched out. So say US has America first, but China is also now, more nationalistic in terms of supporting their own home brands. When it comes to their purchases. Okay, so on the trade deficit, in terms of US dollar billion, is roughly the same, but as a share of Chinese GDP is shrunk from one presidency to the other. So the same, same for share as a percentage, of GDP. But nonetheless, do think that the administration, is also aware of changes. So which is why I find the 100% tariff, on BRICS also reflecting, that recognition that the trade war, that's in the second term will have to be of a different nature. Okay, so let's look at the BRICS, the trend. Okay, so the trend is that BRICS will hit BRICS with 100% tariff, and then and you end excess. They can't sell to US markets. Okay, so then the condition, these days he likes to put condition pledges. So which is quite challenging. Okay, the one for BRICS is not to create a BRICS currency. Okay, so and then not to back any currency to replace the dollar. So I think generally we all know that even if a BRICS currency is created, it will not challenge the US dollar dominance. In any case, the creation is already, if you look at the original members' response, there's a lack of unity. So India has been very vocal, that no step has been taken to de-dollarize. South Africa, denies plan to create. So of course, Brazil, wants it, and Russia, because of the sanctions, these foreign reserves, would also want it. Then China, essentially, is dealing with the US policy. So it basically wants, relations to return to normal. So, but in any case, I think if you look at, but one thing is very fascinating. I think the BRICS story has become more interesting because we've moved from 5 original members. This year we've added 4. So UAE, Egypt, Ethiopia, Iran, Saudi Arabia has been invited, but sort of, not decided. And in Asia, Southeast Asian countries, Vietnam, Thailand, Malaysia, Indonesia, they become partner countries. I think they're keen to join, but nonetheless, so unlike Trump 1.1, the net now, for tariffs to hit countries is also wider. Bearing in mind that Trump did pledge universal tariff, before his victory. Okay, then coming to the top 20 trade deficits, Tieying just now has shown, I think, sort of similar, but mine is the first 10 months of this year. So, so quite clearly, you can see that most of the currencies that is on the US Treasury's monitoring list for manipulation are from Northeast Asia, and Southeast Asia, and of course one Germany, So, and no surprise that they are also for most of the experts for Singapore, they are the top 10 trade deficits that the US has with. Singapore actually has a surplus. But nonetheless, if you look at the top 20, you also see, that most of the countries are color-coded. Red are from Asia and blue from Europe. So, so as I've gone back, bringing back to the earlier slide, why we changed, because one, apart from, let's say, reduced Fed cut expectation, increased tariff risk, and of course, a weak Europe, that's also at risk of facing more tariff challenges in multiple ways. Okay, so one last point that I'd like to make is that in the first term, while many countries didn't get hit by tariffs, but but that doesn't mean that they were unscathed. So Vietnam, for example, they've been trying to elevate their status as a non-market economy, but US has so far been only interested in giving them the diplomatic recognition. Okay, so Indonesia, wasn't spared from ending the GSP, which was globally, and that sort of affected all the countries that were on it. And India, so of course, they also terminated GSP, so and you can find that in many of these Asian countries, there will be a greater push for market access for US goods, and of course from the larger, I think Northeast Asian countries to invest and build production in the US. So in summary, that's how we see at least the first half of next year going for currencies in 2025.
Okay. There are a couple of questions on Pigeonhole. Thank you, Philip. One actually related to you, so let me put them on the screen. Sing dollar related question. James, I hope the Pigeonhole thing is picking this up. Okay, even as if the screen comes up, let me just read it to you, Philip. It's a simple question. Under which circumstances can USD SGD go past 1.40 in the first quarter of 2025? And what probability would you attach to that scenario?
I think at this point we have a forecast about 136, 137. We are, like I mentioned earlier, we are going to monitor what the actual policies, when Trump comes into office, and how, let's say, China, Mexico, Canada respond, and how the Fed is pulling back. I think my bigger concern is whether this trade tensions, would, I think generally we all have this sense that it is positive inflation for the US and maybe negative growth, for especially the exporting countries. So in that regard, I wouldn't put it past dollar Sing moving up 140. Let's say if in the new year, the global economy turns out weaker than expected. You see, the thing about Trump 1.0 during the tariff is that, when Trump got elected, there was the Trump trade, right? The dollar went up. Then, but, we were all caught off guard when the dollar fell in 2017. So that was pretty much rebound in the global export cycle. But this time around, we're hearing that trade has actually recovered this year. But and then it's picked up by companies, suppliers trying to beat the tariff deadline. So what if this turns out to be a sort of Y2K scenario as well? So that's something to keep in mind. So if that comes to pass, then we probably still have more Fed cuts and not be thinking about hikes, but it won't be for a positive reason.
Right. Thank you. Next question also for you, Philip. Here we go. Can you discuss your relatively bullish view on the CNY, given today's news that China is contemplating a weaker currency going into the new year?
I don't. We don't have a bullish.
Let's put up the forecast. Yeah.
Okay.
So you have it appreciating from 726 now to 710 at end.
729. Yeah. Yeah, we probably need to revise this number going forward. As I think what is more instructive is this chart here. Which looking at the experience of 2018.
Okay.
So I think but we are awaiting more, as I mentioned earlier, details.
Yeah.
So I think we want to make it very clear that the forecast is not cast in stone.
Of course.
We will have to move as we get more information.
Right. But I think what we should focus is some of the tactical trade ideas we have with the short term in mind, which of course we will be talking about in the coming weeks and months. Finally, Tieying, quick question. It's a complicated question, but you get only 60 seconds to answer it. How are Japan and Korea managing their relationship with China?
Japan, Korea, in fact, companies that have been adopting the so-called China Plus One strategy in the past several years, moving more of the production from China to South Asia, or even investing more in the U.S. Semiconductor sector, in automobile sector. Under Trump 2.0, I think this diversification will continue. Probably Japan, Korea, the trade investment ties with the U.S. will strengthen further. However, there is also a chance for them to improve relation with China. Because from China perspective, they will be actually will be very proactive to promote those intra-regional trade integration, economic integration to counter the impact of U.S.-China trade war in the coming years. So they may want to strengthen ties with Asian countries, including Japan, Korea. And Japan, Korea, domestically, as mentioned, in fact, there is also some politics change. So Japan nowadays, the lower house is split. So more different voices from different parties. And Korea, if President Yoon steps down and if the opposition party takes in charge, there's also a possibility for these two countries to maybe improve relations with China.
Very
I think it's also possible.
Wow, lots of moving parts. These used to be boring countries, Tieying, and now coming into late 24, early 25, lots of headlines, lots of interesting things. So I think early 25 will be a fascinating period. As we said earlier in the note that we published on Monday, that right now nobody wants to fight the Trump trades, but I think by Q1 of next year, very interesting tactical trading opportunities will come in. So Philip will get busy, and William, his colleague on FX side, will get busy, and Eugene and Samuel in our rate side, they'll get busy with lots of different trade ideas because we will have winners and losers and strategic plays around Trump 2.0. So keep an eye on all that. But until then, season's greetings, Merry Christmas, and Happy New Year to everybody. Thank you, Tieying, Philip, and we will see you in the new year. Everybody, stay safe, stay healthy. Bye-bye.